Hello and welcome to BEC, Business Environment and Concepts. So in this part of the CP exams, you're going to learn about how to effectively, efficiently manage your businesses, or how do you advise your clients how to manage them. Now in BEC 1, we're going to start with looking at corporate governance. So we know the structure of corporations where you have separate owners and separate managers. So you got the stockholders who are the owners of the corporation. Now these guys, they appoint the board of directors who then hire in the management to manage the operations of the corporation. So you got the owners who are separate from the managers who run the operations. Now we got to make sure that these managers, they act in the best interest of the stockholders. They maximize the long-term wealth of stockholders. How do we do that? How do we make sure these guys, they act well? By having an effective corporate governance. So corporate governance ensures that management, they're the agents of the corporation, they act in the best interest of the stockholders. Now, an effective corporate governance involves having an appropriate legal structure for the corporation. It involves having the right kind, the right mix of executive compensation for these guys, for the management, to make sure they are properly incentivized to act in the best interest of the owners, the stockholders of the corporation. And apart from that, we also going to have a lot of monitoring devices to monitor their work. And these monitoring devices, they're going to be internal within the company as well as external. So now let's start with first looking at the legal structure of the corporation. So an effective corporate governance requires that you have an appropriate legal structure. So let's first start with talking about how a corporation is formed. So a corporation is formed by filing articles of incorporation with the Secretary of State, who would then issue the certificate of incorporation. So we're looking at articles of incorporation. Now the articles of incorporation include the proposed name of the corporation, its initial address. It includes the purpose why the corporation is formed. It talks about the powers of the corporation. Apart from that, it also has got the name of its registered agent. It's got the names and addresses of each incorporator, as well as the number of shares and the type of shares that the corporation is authorized to issue. Now, got to remember that articles, they can be subsequently amended only by a shareholder vote. So you cannot have the board or the management amend the articles. You got to have a shareholder vote for any amendment to these articles of incorporation. Generally, it's a majority vote. It could also be 2/3 vote of stockholders. Now, after the articles of incorporation, we'll talk about the bylaws of the corporation. Now, these are like internal rules of the corporation. So these set forth the manner of election or selection of this board of directors, management, how the officers need to be elected or selected, the types and duties of the officers, the conduct of meetings. So you're going to have stockholder meetings, the board of directors meetings, the required meetings for the corporation. Along with that, we'll also talk about stockholder or shareholder rights. Now, we already talked about certain matters which require shareholder vote. For example, let's say you want to amend these articles. You need a stockholder vote for that. Let's say there are some fundamental changes in the corporation, like mergers, like liquidations. Again, it requires a shareholder vote. Now, shareholders, they appoint the board of directors who hire the management. Now, the board also has a lot of other key responsibilities. Let's say the board declares dividends which are to be paid out to shareholders. The board decides whether it wants to go out to the market and buy back the corporation stock. It would be called treasury stock. So these are two good ways of giving back money to the stockholders. So number one, they could give out dividends. Number two, they could go to the market, buy back stock. So that is something which the board decides. But once the dividend is declared, then the shareholders, they have a right to receive the declared dividend. They become creditors to the extent of dividends declared. Now, we said shareholders, they're going to appoint the board of directors who are going to hire the management. So shareholders, if they want, they can get off the board of directors, get a new board in. If they don't like the management, they'll ask the board to change the management. But can it be vice versa? How about the management, the board of directors, they don't like the shareholders? Can they dilute the equity of the shareholders? No, they can't. So that's the preemptive right of the shareholders, which says that if the management, the board, they're issuing out additional stock, the shareholders, the existing shareholders, they have a right to subscribe to that stock so that their equity is not diluted. So we can have the shareholders get off the board, get off the management, but you cannot have the board or the management get off the shareholders. That's important. Now, shareholders also have a right to go to the company, go to the corporation, inspect the books and records of the corporation. They also have a right to sue on behalf of the corporation. So let us say the directors, they are not living up to their fiduciary duties. Let's say some directors, they declared dividends illegally. So you can have the shareholders sue the directors on behalf of the company. Let's say the management, one of the officers, they were involved in corporate fraud. So you can have the shareholders sue the management of the company. So the shareholders can sue on behalf of the company. So guys, all these facts, they make sure that there is an appropriate legal structure of the corporation to ensure effective corporate governance.
On page 2, we're looking at an overview of corporate governance. And we know that corporate governance is about ensuring that right management, which takes care of the operations of the entity, acts in the best interest of Run Arrow and right stockholders or the owners of the corporation. And one of the most important monitoring devices in place is right the board of directors. So draw an arrow from stockholders to the board of directors, because it's the stockholders or the owners who appoint the board of directors, who then put an arrow to management, hire the management to run the company on behalf of the stockholders. And this flow is a very important flow for you to understand corporate governance. Move to page 3, where we're looking at the legal structure of corporations. Now, highlight corporate law in the US includes, highlight state statutes. So, every corporation in the US is governed by state law in which it is incorporated. Now, the state laws slightly differ across states, but many states follow the structure of the Model Business Corporation Act, which is a model statute drafted by the American Bar Association. Many large corporations incorporate in states like Delaware, which have a favorable corporate legal structure and regulations. The next source is highlight federal statute, whereby highlight public companies are required to comply with the federal securities laws, which include the 1933 Act, the 1934 Act, the Sarbanes-Oxley Act, Dodd-Frank Act, Jobs Act. So all these federal securities laws which are enforced by the SEC or the Securities and Exchange Commission. Then you got common law, you have internal law. So corporations make their own internal law mainly through highlight the articles of incorporation, also called the certificate of incorporation or the corporate charter. Now, this is filed by the corporation with the office of the Secretary of State in the state where the corporation decides to incorporate. Now, these articles of incorporation typically include underline name of the corporation and its initial underline address, underline number of authorized shares, name, address, and signature of underline each incorporator, underline the purpose of the corporation, and the name and address of the registered agent of the corporation. Any amendment of the articles of incorporation may need shareholder approval, majority, or even two-thirds approval. Next, highlight bylaws of the corporation, which contain provisions for managing the business and regulating the affairs of the corporation. For example, the election or selection of directors and officers, required meetings, manner of conduct and quorum of meetings, responsibilities of officers, etc. Move to page 4 and put a box around shareholders' rights. Now, the shareholders of the corporation have the right to highlight elect the board of directors. They have a right to highlight vote on certain matters, which of course includes underline electing the board of directors, or making proposed corporate changes. Example, underline amend articles of incorporation, or matters that affect their ownership, which is stock split or a merger and acquisition. Shareholders have a right to highlight receive dividends if declared by the board of directors and circle if. Shareholders have underlined a preemptive right. That's the first option to buy. So before stocks are offered to outsiders, existing shareholders are given the option to highlight purchase stock so that their ownership is not diluted. This is also called right subscription right. Shareholders have the right to highlight inspect books and records of the corporation in good faith and for a proper purpose. And shareholders also have the right to highlight sue on behalf of the corporation. For example, if the shareholders' rights are violated or if there is a wrongful act committed by the directors or officers. Next, we're looking at put a box around board of directors who are highlight elected by the shareholders. Now, all corporate powers are exercised by or under the authority of the board. The board has underlined collective power to bind the corporation. The board of directors manage, direct, oversee the business and affairs of the corporation, including appointment, that's highlight hiring and firing of the top management, and draw an arrow from this sub bullet downwards to the next major bullet where we'll talk about the top management or the officers. Now, the board of directors also authorize distribution to shareholders. For example, highlight declaring dividends or share buybacks. The board also has highlight oversight responsibilities. And now on the next bullet, put a box around officers who are, as we discussed, highlight appointed by the board of directors. And the officers highlight act as agents of the corporation. Officers have a duty to act in good faith, with due care, and in a manner the officer reasonably believes to be in the best interests of the corporation. Highlight officers are responsible for the financial statements. Highlight officers are also responsible for internal controls.
For effective corporate governance, we also need to set executive compensation so as to align management's decisions, their actions with the long-term interest of the stockholders. So if we pay the management a lot of fixed compensation, a fixed salary, they might get complacent. They might get busy playing golf, or they might not want to take risks. How about we pay the management a lot of incentive based compensation based on accounting profit or the short term stock price? Now profit, they might try to manipulate or manage the books of accounts, manage profit numbers. They might want to take excessive risks so as to increase the short term stock price, because here their perspective is going to be short term stock price, but the stockholders, they are interested in the long term stock price. So guys, it's very important that we align the interest of the management with that of the stockholders so as to have the right kind of corporate governance. So with this perspective, let's talk about the various kinds of executive compensation and find out what's the best mix for these guys. So let's look at executive compensation. Okay, so let's first start with looking at base salary plus bonus. Now again, the problem with bonus is it's based on accounting profit. Now the question is, has the management managed the profit? So let's say they had some R&D expense. Instead of doing it this year, they said we're going to do it next year. Why? Because they wanted to increase the profit numbers for this year. So that's managing profit numbers. Now they could even cook up the books of accounts, show higher profit numbers to get higher bonuses. Now that's a risk of manipulation. So whenever we're looking at bonuses for accounting profit, the perspective here from the management side is short term. The stockholders, I said, they're looking at long term. So the issue here is short term. That's the key issue with bonuses based on accounting profit. Management, they often issued stock options. So basically, if the stock price increases, their compensation increases, their incentive increases. So let us say the stock of a corporation is trading at $500 and management is issued options where they can exercise it at $500. Now, if the stock price goes above $500, let's say it becomes $600, management can exercise their option at $500. So that's a $100 gain for them. So they would really want the stock prices to go up. Now, an issue here could be, again, management, they might look at short-term stock prices. They might take risks in excess of stockholder appetite because they are interested in the stock price going up so that their options are in the money. They can make money out of their options. So the issue here is short-term. Now, another problem with stock options could be, let us say the stock price tanks. So you got stock options issued at $500, stock price becomes $300. Now management knows their options, it's out of the money. They'll never yield any returns. So now they don't have any incentive to act in the best interest of stockholders. So that's an issue with stock options. Either excessive risks or they could even get underwater. Now, another form of executive compensation which is very interesting is stock grants. So here, instead of issuing options, the management, they are getting stocks, they're getting shares as part of the compensation. Now, generally, stock grants, they are restricted. So let us say, we say that management, they can't resell the stock for 10 years. So now management, they would try to act such that the stock prices increases. Now because it's a long term, 10 years, again management would be interested in long term stock price in line with what the stockholders want. So this could be very interesting. So here, let's say it's 10 years. The good thing is this becomes long term. Now, stock grants could also be performance shares. So that's shares issued out to management if certain levels of performance are met. So you want them to perform well if you want the corporation stock. Now, management, they also get a lot of executive perks. So they have a lot of retirement benefits. They are allowed to use corporate assets, the corporate jet. They are given golden parachutes. So let's say the corporation is like an airline, it's flying. So you have a bigger airline, a bigger aircraft coming in, acquiring the corporation. The management, they are worried because now they would be jobless. So we give them golden parachutes to jump out of this aircraft. So guys, what it means is if a corporation is taken over or merged, the management, the officers, they will receive significant benefits, golden parachutes. So we have all these options to give as executive compensation. Now, what's the best form of executive compensation? Now, what we'll do is we'll mix and match. So what we could say is the best form of executive compensation is a little bit of fixed salary. Everybody needs that. Plus, we'll give them some incentive based on the long-term stock price. So let's say we can give them stock grants based on long-term stock price or stock options which vest after a long term, let's say after 5 years. So incentives based on long-term stock price. Because guys, the perspective of stockholders is they're looking at long-term stock price, not short-term. And plus, we would give them a bonus. But that bonus would be based on a mix, a composite of performance measures, not just accounting profit. So bonus based on composite performance measures. So here we'll not only look at the dollar numbers on the financial statements, not only look at the net profit numbers, we'd also look at the research and development that happened during the year. The number of new products that management launched this year. So new products might not mean a lot of profits now, but it could mean a lot of profits in the future, long term. We would look at the percentage stock held by institutional investors. So that again is a long-term perspective. So guys, we'll talk in detail about performance measures or performance systems where we look beyond the dollar numbers on the financials. We'll talk about a balanced scorecard when we get to BEC 5. But now, looking at executive compensation here, we know we have a lot of options here, but this one could be a right mix to ensure effective corporate governance, to ensure the management, the executives, they act in the best interest of stockholders. They also have a long-term perspective.
On page 5, we're looking at the various forms of executive compensation. So on the second bullet there, highlight base salary and bonuses, where bonus is generally measured as a percentage of highlight accounting profit. The cons is that accounting profit may be managed or even manipulated. Or this could lead to an increased emphasis on highlight short-term profits rather than maximizing long-term shareholder value. Executive compensation could also be in the form of highlight stock options, where executives are incentivized to increase the stock price. Now, the cons here is that it may result in increased emphasis on highlight short-term stock price rather than again maximizing the long-term shareholder value. It could result in excessive risk taking by management, highlight risks exceeding the organization's risk appetite and circle risk appetite. There could be no motivation at all if the stock price drops significantly, such that the stock options become, as we call them, underwater. Executive compensation could also be in the form of highlight stock grants, where managers are issued equity stock as part of compensation. It may be retired stock, which underline cannot be sold for a specific time period, say 10 years. Now, this encourages managers to focus on maximizing highlight long-term shareholder value. Stock grants could take the form of performance shares, which are issued to managers if certain performance levels are met. For example, the EPS targets. And of course, executives are often entitled to many highlight executive perks. For example, healthcare, insurance, retirement benefits, use of corporate assets like the corporate jet, paid vacations, corporate loans, or highlight golden parachutes. Now, an highlight effective form of executive compensation often combines highlight fixed and incentive based compensation related to the long term stock price. For example, restricted stock that may be sold only after 10 years. Also, highlight any bonus should ideally be based on comprehensive performance metrics rather than just profits. For instance, the entity could use underline balanced scorecard. And we're going to study about balanced scorecard and write BEC 5. So the balanced scorecard not just looks at profits or the financial perspective, it also looks at are the customers happy, the customer perspective. It looks at the internal business process perspective, and it also looks at the employee learning and development perspective. So guys, instead of just looking at profits or financials, it sort of takes a holistic overall view of performance management. On page 6, we're looking at a few regulations that impact executive compensation of public companies or issuers. First one, as you could guess, is put a box around the Sarbanes-Oxley Act or SOX, which was passed in 2002, which prohibits personal loans to directors and officers. It prohibits insider trading by officers or directors during certain blackout periods. It provides for forfeiture of certain bonuses and profits, clawback. So the bonuses and profits of the officers can be clawed back by the entity, underline in case of a financial statement restatement by an issuer due to material non-compliance of financial reporting regulations, where underline the CEO and the CFO need to reimburse the issuer any bonus or incentives or any equity-based compensation that they have received or profits realized from the sale of securities of the issuer during underline the 12-month period after the issuance or filing of these financials, which are now being restated. Now, after the financial crisis in the year 2010, the US Congress enacted, put a box around the Dodd-Frank Act, which imposed additional requirements for issuers relating to executive compensation. It requires a compensation committee of the board of directors comprising of only independent directors. It provides for a say on pay shareholder vote, where shareholders vote to approve executive compensation at least once every 3 years. The Dodd-Frank Act also requires highlight disclosure of pay versus performance. That's the executive compensation or pay versus the entity's financial performance. The Dodd-Frank Act requires highlight disclosure of others versus CEO compensation. So in SEC filings, the issuers need to disclose A, the median of annual total compensation of all the issuer's employees except CEO. B, the annual total compensation of the CEO. And C, the ratio of A to B. So that's others versus the CEO compensation. The Dodd-Frank Act also requires highlight disclosure of hedging by employees and directors. It provides for recovery of erroneously awarded compensation. Again, highlight clawback. So underline, in case of a financial statement restatement due to any material non-compliance with any financial reporting regulations, the issuer would recover any excess incentive-based compensation, including stock options, paid underline to an executive officer during underline the 3-year period preceding the accounting restatement date. And given that the Dodd-Frank Act was passed after the financial crisis, it of course required highlight enhanced disclosures for financial institutions who need to disclose whether the existing compensation structure provided any excessive compensation or benefits or could lead to a material financial loss to the financial institution.
For effective corporate governance, we also have a lot of monitoring devices which monitor the decisions, the actions of the management. And one of the key monitoring devices that we have in place is the board of directors right here. So it's the board of directors that hire the management. So the management, they are not doing the right job, the board is going to fire the management, get a new management in. Now, the board of directors comprises inside directors as well as outside directors. So inside directors would include, let's say, the management. So you have the CEO, CFO, they are also part of the board of directors. You could have major stockholders in the board of directors. But it's required that for public companies, the majority of this board be outside directors. So that's independent directors who are not part of the management. Now, this is important, very important in ensuring effective governance oversight by the board of directors. So because majority of the board is independent of the management, if the management is not doing the right job, they could very easily be fired. So we know that the board of directors, they take care of hiring, firing the management. They declare dividends to stockholders. They decide whether they want to go out and buy treasury stock. The board of directors also ensures strategic direction and guidance for the corporation to the management. So let's look at monitoring devices, and we're starting with board of directors. So let's get on there. So we looked at legal structure, executive compensation, and now monitoring devices for corporate governance. We're starting with looking at the board of directors, and it's very important to remember that majority of this board is independent. So majority is independent. Now the board of directors has got a lot of committees. One of the key committees is the corporate governance committee or the nominating committee. Now, this committee oversees the organization of the board of directors. It determines the director qualifications, any required trainings for directors. It develops corporate governance principles for the corporation. It oversees succession of the management, let's say the CEO succession. Then you also have a very important audit committee. And this is an independent committee as per SOX requirement. So this is required as per the Securities Act, the Sarbanes-Oxley Act, and also the regulations of NYSE, NASDAQ. So what they say is, out of the board of directors, we're going to form an independent audit committee, which means that all the members of the audit committee are independent of the management. And at least one of those members in the audit committee is a financial expert who knows about GAAP, who knows about audit, who understands the auditors, who understands the business. So it's the audit committee which takes care of the external auditors as well as the internal auditors. So let's get on the dashboard, look at it. So you got the board of directors, which comprises both inside and outside directors. So you have the management also sitting on the board. Now what we'll do is, we'll pick up the independent members out from the board of directors. And out of few of them, we're going to form an independent audit committee. So none of the members on the audit committee are part of the management. Now the audit committee would be appointing the external auditor. So let us say the auditor comes in, the independent external auditor, he comes in, he finds issues with the management, he finds issue with the books of accounts. He can go to the audit committee and talk to them about it. And the audit committee, they're going to pick up the management, discipline them. Because audit committee, they are independent of the management. So on the board of directors, you have inside directors, that's management as well as independent directors. But on the audit committee, you only have independent directors. So the audit committee appoints the external auditors. It decides the compensation for external auditors. It oversees their work. And there's a special focus on discussions, communications happening between the auditor and the audit committee. Now, even the internal auditors who are working within the company should have access to the audit committee. So let us say the internal auditors find some issue with the management, they should be able to get to the audit committee, let them know of the problem. So that's very important. We'll do this again when we're doing auditing, but this is a very important point for corporate governance, the independent audit committee of the board of directors. So we looked at the nominating committee, the audit committee. You also need to have a compensation committee. Now, as part of the Dodd-Frank Act of 2010, it's required that all the members, even for the compensation committee, be independent. So the compensation committee reviews and approves CEO's compensation. So they decide what they're going to pay to the CEO. For the rest of the company, the CEO is going to look into it. They recommend incentive and equity-based compensation plans, generally for the management. They make sure that they align the interests of the management via executive compensation with that of the stockholders. So that's the compensation committee which takes care of this, which decides what's the best compensation that you want to give to the executives, to the management. Now, as per the Dodd-Frank Act, it's also required that shareholders be allowed to vote on executive compensation and golden parachutes at least once every 3 years.
On page 7, we're looking at the monitoring devices for corporate governance, which include monitoring by highlight internal stakeholders like the board of directors, internal auditors, shareholders, as well as highlight external stakeholders like the external auditors, the stock exchanges, SEC, analysts, credit agencies, attorneys, or the IRS. Now, external stakeholders like external auditors, analysts, credit agencies, and attorneys often play the role of gatekeepers for corporate governance. Let's now look at the most important monitoring device, which is put a box around board of directors. Now, the board is responsible for the appointment or highlight hiring and firing of the top management. The board authorizes distributions to shareholders, which could be by highlight declaring dividends or share buybacks. The board also has highlight oversight responsibilities. Now, moving down, we have that for public companies or issuers, it is required that highlight majority of the board members be independent. Moving down further, we're talking about a few key board committees which play an important role in the oversight of the entity. Highlight nominating committee or the corporate governance committee. The SEC requires disclosures whether the members of the nominating committee are underlined independent. However, the national securities exchanges like the NYSE or the NASDAQ require that the nominating committee comprises only of independent directors. The nominating committee is responsible for identifying candidates for directors and to organize the membership of the board and its committees. The nominating committee is supposed to recommend governance principles and practices. Turn to page 8 and highlight audit committee, which comprises only of underlined independent directors. The audit committee is mandatory for all public companies pursuant to the Sarbanes-Oxley Act or SOX. Now, SOX also requires disclosure whether highlight at least one of the members of the audit committee is a financial expert. Now, the audit committee is responsible for overseeing the entity's accounting and financial reporting processes. They look at the officers who are required to disclose key matters to the audit committee. Even underlying internal auditors should have access to the audit committee. The audit committee appoints, compensates, and oversees the work of underlying the external auditor who should report directly to the audit committee. Next, highlight compensation committee, which is mandated for all public companies by the Dodd-Frank Act, and it's required that the compensation committee comprises only of underlying independent directors. Now, the compensation committee is responsible for overseeing compensation plans for the CEO and other officers.
Another very important monitoring device is the stock exchange where the corporation is listed. So let's say we're looking at the New York Stock Exchange or the NASDAQ. Now, these stock exchanges have pretty stringent requirements for corporate governance and for director independence. So both the stock exchanges require that majority of the board of directors be independent. Now, they got specific rules for director independence. Now, they require that the corporation have an independent audit committee which looks into the external auditors and the internal audit function of the company. Now, the stock exchanges also require that corporations have a code of conduct which is applicable to all the directors, all officers, and all employees of the company.
Back on page 8, put a box around stock exchanges. Now, the requirements that we have here apply to NYSE or the New York Stock Exchange listed companies, though NASDAQ requirements are also pretty similar. Highlight listed companies must have a majority of independent directors on their board. Move to page 9. Highlight executive sessions. Now, to empower non-management directors to serve as a more effective check on the management, highlight the non-management directors of each listed company must meet at regularly scheduled executive sessions without the management. Now, non-management directors are those directors who are not executive officers. Now, these non-management directors may or may not be independent. And so the listed company should also highlight hold an executive session including only independent directors at least once a year. On the next sub-bullet, highlight board committees, where listed companies must have highlight a nominating or corporate governance committee composed entirely of underlying independent directors. The listed companies must have highlight a compensation committee, again composed entirely of underlying independent directors. Also highlight audit committee, which should also be composed of underlying independent directors. Next sub-bullet, highlight shareholders must be given the opportunity to vote on all equity compensation plans. Highlight listed companies must adopt and disclose corporate governance guidelines. The last one here, listed companies must adopt and disclose a code of business conduct and ethics for directors, officers, and employees.
Now, even internal auditors of the company act as an important internal monitoring device. So you have the internal auditors who look into the risk management activities of the corporation, the internal controls of the corporation, and the governance processes within the company. So we want the internal auditors to be competent, have the right kind of knowledge, maybe a CIA, a certified internal auditor. And not only competent, we want them to be objective. So we are looking at competence and objectivity. So we want them to be independent of the functional areas they audit. So let's say the departments within the company, they have their own managers who take care of the department performance, department controls. The internal auditor comes in, he reviews and audits if the departmental managers, they are doing the right job. Now, administratively, we have the internal auditors reporting to the CEO. So you have the internal auditors working as employees within the company. So administratively, they are reporting to the CEO. That's fine. But functionally, we want them to report to the audit committee. So let us say if the internal auditors have some issue with the management, they can go to the audit committee and talk about it. And this one ensures the right kind of objectivity that we are looking at for internal auditors.
Let's get a page 10 and put a box around internal auditors who help improve, highlight corporate governance processes, internal controls, and risk management. Now, internal auditors, right, must be competent plus objective. On the next sub-bullet, underline for higher objectivity, highlight the CAE or the Chief Audit Executive should report functionally to the audit committee and administratively to the CEO. Basically, the internal audit function should have direct access to the audit committee. On the last sub-bullet there, highlight Institute of Internal Auditors, IIA, is the international professional organization that offers highlight the CIA or the Certified Internal Auditor certification. The IIA issues professional standards for internal auditors. They've issued highlight the international standards for the professional practice of internal auditing.
Now, we've seen that how board of directors and the internal auditors, they play a very important role as important internal monitoring devices to make sure that there is effective corporate governance. Now let's talk about external auditors who act as a very important external monitoring device. So external auditors, they are hired by the independent audit committee. So they are independent expert auditors who come into the company. So the management here, they prepare the financial statements. Auditors come in from outside, look into those financials. So when we get to auditing and attestation portion of the CPA exams, I'm going to be wearing the hat of an external auditor. So then I'm going to be teaching you how the external auditor, he comes into the company, looks at the management's financials, gathers sufficient, appropriate, corroborative audit evidence around these financials and expresses an opinion on these numbers. So management, they're preparing the financials. The auditor, he comes in, expresses an opinion on the financials. So I'm going to tell you, management, they are responsible for the financial statements. They've prepared it. The auditor expresses an opinion on these financials. He is responsible for his opinion. Now, as per SOX, the Sarbanes-Oxley Act of 2002, the auditors for public companies, for issuers, need to comply with the standards of the Public Company Accounting Oversight Board, PCAOB. And here, they are not doing just one audit, they're doing two audits, an integrated audit. So now the auditor steps in, he looks at the management financial statements, expresses an opinion on these financials. He also looks at the internal controls that management has in place which create these financials. He looks at the internal controls over financial reporting and he expresses two opinions. Opinion number one on the financial statements. Opinion number two on the internal controls over financial reporting. And naturally, the auditor has a lot of ongoing communications with the independent audit committee. Guys, this word independent for the audit committee, it's important because anybody who's there on the audit committee is not participating in the management of the company. So let's say the auditor has some disagreements with the management. They can tell that to the audit committee and the audit committee can discipline the management. Let's say there are some uncorrected misstatements on these financials. The auditor would inform the audit committee who would take a call on this. They've got some significant issues with the management. They're fighting with the management. Go to the audit committee, tell them. Let's say the auditors, they have found certain significant deficiencies or material weaknesses in management's internal controls. They'll inform this to the independent audit committee. So that's how the auditors play a very important, very effective role as monitoring devices to make sure that the management, they are acting in the best interest of the stockholders, to make sure that there is effective corporate governance. So let's quickly put external auditors as one of our important monitoring devices on this side of the board. So we have board of directors, the stock exchanges, we looked at internal auditors, external auditors. So they look at the financial statements and they look at the internal controls over financial reporting, express opinions on both these. Integrated audit as per requirements of the PCAOB, the Public Company Accounting Oversight Board. Now, very important, the communications of the auditors with the independent audit committee. So there's a lot of communication that's happening from here to the audit committee. So the audit committee, they appoint the auditors. They look into the oversee the work of the auditors. And naturally, there's a lot of discussions happening between them. Any issues with the management, any issues with the financial statements, with the internal controls, all that goes out from the auditors to the independent audit committee. Make sure that there is effective corporate governance. Make sure there is a very effective monitoring device out here.
Let's go to page 11. We're looking at put a box around external auditors who are appointed by the audit committee and who play a critical gatekeeper role. Now the auditor has a lot of communications which goes on with the independent audit committee. So highlight auditor communications and your mnemonic to remember all these auditor communications is as is sum of all wows. So the auditor should communicate information to the audit committee as is and include sum of all wows. Now, we're going to do this mnemonic in detail when we look at auditing. But for now, for BEC, fill in the bubbles there. A, S, I, S, as is, sum of wow. SUMVOW. Now the A of as is highlight auditor's responsibilities. So the auditor needs to communicate with the audit committee the auditor's responsibilities with regard to the financial statement audit, which is to express an opinion on the financial statements. The S of as is highlight the scope and timing of the audit as planned. The I of is highlight internal control issues identified in an audit. The S of is highlight significant findings and issues on the audit. These significant findings and issues are elaborated by a mnemonic sum of all wows. So these include any significant difficulties encountered during the audit, any uncorrected misstatements, management and auditor disagreements, views of the auditor on qualitative aspects of the entity's significant accounting practices, other findings or issues, and issues when not all of those charged with governance are involved in management, where they need to be briefed about things that they might not be aware of. Now, the Sarbanes-Oxley Act, SOX, which was passed in 2002, brought about a lot of implications for the auditors of issuers or the auditors of public companies, whereby highlight the PCAOB, the Public Company Accounting Oversight Board, was established to regulate these auditors of issuers. Highlight stringent auditor independence requirements. For example, auditors can no longer perform consulting services for audit clients. And the requirement for highlight integrated audit for issuers, whereby auditors are required to express their opinion on both financial statements as well as internal controls over financial reporting, ICFR.
Now let's look at a host of other monitoring devices which make sure that management, they are rightly monitored. They act in the stockholders' best interests. So we looked at board of directors, stock exchanges, internal auditors, external auditors. How about investment bankers and securities analysts, equity research analysts? So investment bankers, they come in whenever the management, they want to raise equity, they want to raise debt. So they evaluate the company before issuing out the securities, before selling the securities, before underwriting them. So that's a good monitoring device, it's good check on the management. Security analysts, so they give recommendations on the company's stock. So they tell the investors whether to buy, hold or sell the company's stock. So if it's a bad management, they would tell the investors that's not a company worth investing, sell the stock. If it's a good management, they're doing a good job, they would tell investors to buy stock, increase stock price. So they are good monitoring devices. How about creditors? So here we could be looking at lenders of the company which have debt agreements with covenants or certain requirements which management needs to comply with. So let's say lenders have given loans to the company and require that the company maintain certain levels of working capital ratios. It may discipline the management as the covenants may require the management not to borrow more loans. It may limit certain executive compensations. So all that is good monitoring, good check on the management. We can look at credit rating agencies. Now, these agencies, they determine the credit worthiness of the company's bonds, of the corporate bonds issued out. So they could give ratings like AAA, excellent. So they could give AA, single A, BAA. So it's something like security analysts, they act as a good monitoring device. They tell us how good the management is, how good the company is doing. Now, under the Dodd-Frank Act, there have been provisions that prevent conflict of interest of these credit rating agencies and increases transparency so that we can use them as effective monitoring devices. How about attorneys of the company? Now, attorney-client, there is privilege. So attorneys would never go out and tell anybody else, but then they would review the company's, let's say, securities filings. They would provide important advice to the management on legal matters, would have a good check legally on what the management is doing. Then we've got the very important SEC, the Securities and Exchange Commission. Now the SEC is responsible for protecting the investors. It's responsible for maintaining fair, orderly and efficient markets. Its important function is to facilitate capital formation. Now it's the SEC which enforces the US securities laws. So including the federal securities laws of 1933, 1934, even the Sarbanes-Oxley Act of 2002. Now, several of SOX provisions improved SEC's power as an external monitoring device. So you have the periodic filings by the company. So let's say every quarter, the company, public companies, issuers need to file Form 10Q with the SEC. Every year, they need to file Form 10K with the SEC. Now, under SOX, it's required that the management, the CEO, the CFO sign off on these filings. So if there is a problem with these filings, if there is a material misstatement on these filings, the CEO and CFO would go to jail. So the penalties for securities fraud have been made more stringent, more pronounced after the Sarbanes-Oxley Act, after SOX, which is enforced by the SEC. Then let's talk about IRS, or the Internal Revenue Services. So that's the tax filing for the company. So corporations need to file Form 1120, the corporation income tax return, with the IRS, with the Internal Revenue Services. So the IRS requires that certain accounting information be included on the corporate tax return. Now, if they find any issues, they could audit the corporation's tax return and enforce penalties for filing false or fraudulent returns. So that's a good check again on the management. How about the prospect of corporate takeovers? So let's say the management, they are not doing a good job. They are performing very poorly. Now this corporation could then be subject to takeover by a firm which believes it can more efficiently utilize the resources in here. So guys, the management knows if they're not doing a good job, they will be taken over by another corporation and they lose their jobs. So that's a good incentive for management to make sure they perform correctly, they perform in the best way in the stockholders' interest. So these are all a lot of monitoring devices that I've put here. And let me end this with stockholders or shareholder activism. So guys, here we saw if the company, the management is not performing well, it will be taken over by another company. Now let's talk about the stockholders of the corporation. What would they do if the management is not doing the right job? So let's say the management here, they are not acting in the best interest of the stockholders. The stockholders would tell the board of directors to replace the management. Now, if the board of directors does not replace the management, they would they get the board off, get another board in, they would appoint another board of directors. So guys, that's an important understanding that we need for corporate governance. So if the management, they're not doing the right job, they're not going to be in there. So this is basically the monitoring device that we have. Stockholders are also very important from that perspective.
On page 12, first bullet, put a box around securities analysts who analyze public companies and recommend current or potential investors to buy, hold or sell a particular corporation stock. Now, these analysts, they gather and interpret financial and non-financial information including information about the corporation's management, and they play a critical highlight gatekeeper role. Next, we have put a box around credit rating agencies, which provide credit ratings regarding highlight credit worthiness of corporate bonds, which investors rely on for their investment decision. Therefore, once again, credit rating agencies play a critical highlight gatekeeper role in the debt market that is functionally similar to that of securities analysts who do that in the equity market. Now, the big three credit rating agencies are Standard & Poor's, Moody's, and Fitch. There have been certain key regulations to regulate these credit rating agencies, which include underline the Credit Rating Agency Reform Act of 2006 and underline the Dodd-Frank Act of 2010. On the next bullet, put a box around attorneys. And here we are talking about underline the general counsel, who's the chief legal officer of the corporation, as well as underline outside legal counsel or the outside attorneys or law firms appointed by the entity. Now, these attorneys highlight advise the board and management on corporate governance requirements as well as legal matters. Move to page 13 and put a box around the Securities and Exchange Commission, the SEC, whose mission is to protect investors, to maintain fair, orderly, and efficient markets, and facilitate capital formation. The SEC strives to promote a market environment that is worthy of the public's trust. So, SEC is responsible for interpreting and enforcing the federal securities laws, which include underline the Securities Act of 1933, underline the Securities Exchange Act of 1934. Few lines below, underline the Sarbanes-Oxley Act of 2002, underline Dodd-Frank Act 2010, and Jobs Act 2012. Now, divisions and offices of the SEC that are particularly relevant to corporate governance include underline the Division of Corporation Finance, which oversees corporate disclosure of important information to the investing public. Underline Division of Enforcement, which assists the SEC in executing its law enforcement function. And underline Office of the Chief Accountant, which is the principal advisor to the SEC on accounting and auditing matters. Highlight the SEC impacts corporate governance, especially through its disclosure powers, which require public companies to provide information that investors may need to make informed decisions. Next, put a box around Internal Revenue Service or the IRS, which requires certain key accounting information on highlight the corporate tax return. Also audits the corporate tax returns and enforces penalties for non-compliance or filing false, fraudulent tax returns. Turn to page 14 and put a box around lenders and creditors, which include banks and financial institutions, who act as a monitoring device for corporate governance, especially with reference to the monitoring of the corporation's compliance with highlight debt agreements or covenants. Next, put a box around employees, who act as a monitoring device for corporate governance, especially with reference to the whistleblowing policy, whereby an employee can expose any illegal or unethical information or activity in the corporation. there are certain key regulations that protect whistleblowers. Underline the Sarbanes-Oxley Act of 2002, which provides for highlight whistleblower protection for employees of issuers who provide evidence of fraud. Then we have underlined the Dodd-Frank Act of 2010, which has highlight the whistleblower bounty program, which awards 10 to 30% of collections to someone who provides original information to the SEC that leads to a successful SEC enforcement action, yielding monetary sanctions of over $1 million. The next monitoring device put a box around shareholders, the owners of the corporation, who are critical because highlight if the management is not acting in their best interests, shareholders may resort to shareholder activism. They may even elect a new board. Next, put a box around hostile takeovers. So this is when an acquirer acquires the corporation by directly reaching out to the company's shareholders, generally after the management and board have refused the acquirer's offer. Now, this acts as a monitoring device for corporate governance because it ensures that management does not become complacent or underperforming or inefficient such that the acquirer who pursues the hostile takeover believes that there is a significant value yet to be unlocked.
So I'll take your leave now and let's have your audit instructor take over from me and explain you SOX. In 2001-2002, in the US, we had a bunch of corporate frauds. Most notable is Enron, which was audited by one of the big five back then, that's Arthur Andersen. Enron had created a whole mesh of special purpose entities and did a lot of creative accounting by recognizing tomorrow's revenues today. And guess what? Arthur Andersen, the big CPA firm, signed on all that and said it's all fine. Investor confidence was badly hit. There was a big question mark on corporate accountability, corporate responsibility, and an even bigger question mark on the CPA profession. Guys, there was trouble everywhere. That is when they came out with a bunch of laws which they call the Sarbanes-Oxley Act of 2002. When George W. Bush, president then, signed this law, he said, this is one of the most far-reaching reforms of the American business practices since the times of Franklin D. Roosevelt. Remember, that was after the economic depression of 27 through 33, and they had a bunch of securities laws coming out then, a lot of reforms coming. So this is one of the most far-reaching reforms in corporate America since then. Now, Bush said that the era of low standards and false profits is over. He said that no boardroom in America is above or beyond law. And truly, SOX makes sure of all that. So SOX has got a total of 11 titles, of which we're going to focus on the first 4 titles which are more relevant for our CPA exams. So Title 1 of SOX. This is the title that created the Public Company Accounting Oversight Board, or the PCAOB. So Public Company Accounting Oversight Board oversees the auditors of issuers. So you have issuers, and Public Company Accounting Oversight Board oversees the auditors of issuers. So if you want to go out and audit an issuer that's a public company, you have to register your CPA firm with the Public Company Accounting Oversight Board. Now the PCAOB has a lot of authority. It does peer reviews. It's got authority for suspending auditors. It can impose penalties on auditors. It can even revoke registration of the CPA firms who do not comply with the rules and regulations set by them. So guys, they're very, very powerful. So PCAOB oversees auditors of issuers. As I told you, the auditors, the CPA firms need to register themselves with the PCAOB. So they become registered. So you call them registered public accounting firms. Now, Public Company Accounting Oversight Board also has its own sets of auditing standards. As I told you, when PCAOB was formed in 2002, they decided to follow GAS. They said, we'll start with GAS, but we need much more for the auditors. So they started with GAS and slowly they've evolved and come out with the Public Company Accounting Oversight Board auditing standards, which is GAS plus more. Guys, it's the auditors of issuers, much more responsibility out there. So that is what is the Public Company Accounting Oversight Board, created by SOX in 2002 as per Title 1 of the Sarbanes-Oxley Act. Now, Title 2 of SOX talks in detail about auditor independence. Now, we had provisions for auditor independence in the AICPA code. Remember Rule 101? Now, SOX has much more stringent provisions regarding auditor independence. So if you remember, we had auditors' independence is impaired by business relationships. So we said that a CPA for audit or attest services, you cannot provide non-attest services simultaneously. So it was like an auditor cannot do bookkeeping services for the client. You cannot just prepare these financials and then audit them. So the same rules apply here. You cannot do internal audit services. So you cannot be an internal auditor as well as an external auditor. Certainly not allowed. You can't design, implement financial systems. Not allowed. You can't do appraisal valuation services. You can't do management functions. You can't sign checks. You can't do HR services, legal services. So all that impairs auditor independence. Now, I told you consulting. So let's talk about non-attest services. I told you consulting. Under the AICPA code, Rule 101, we said consulting is okay if the client is a non-issuer, the client understands the recommendations and takes responsibility for implementation. Under SOX, consulting services are not allowed to be provided if you're doing audit or a test. Guys, think about it. Doesn't make sense if I'm going out and auditing this client as well as providing consulting services. Let's say I give some advice to the client and that advice doesn't work that well. The client is going to come back and tell me, dude, you gave me that advice, it didn't work very well. Now I can't tell my users, my shareholders that it didn't work. So I need to cook these financials because that consulting advice, that didn't work well. And then I have to relent and I have to say, okay, I'll sign on this because my advice didn't work. I understand you lost a lot because of my wrong advice. Guys, there's a big conflict of interest here. I'm doing consulting as well as auditing. So SOX said for an auditor, it's important that the auditor does only audit or attest services, not consulting. Consulting is simply not allowed. Even in case of Enron, they had noticed that Arthur Andersen got 70% of its revenues from Enron via consulting services. So Arthur Andersen was doing consulting as well as auditing for Enron. Now they said either do consulting or auditing, not both. So you can either do consulting, you don't need to be independent for that, that's just fine. But if you're doing auditing, you need to be independent. You cannot do consulting. Consulting impairs your independence. Now, how about tax services? Now, for non-issuers, we said if you're doing auditing, tax services is okay because taxes and financial statements go hand in hand and we don't mind the auditor doing taxes. Now, in case of SOX, it requires that if you're doing tax services, make sure it's pre-approved by the audit committee. The audit committee pre-approves that yes, you can do the audit as well as taxes. And it is disclosed to the SEC, to the Securities and Exchange Commission. Very important. Now, along with auditor independence, SOX requires audit committee pre-approvals and communications. So SOX requires that all services provided by the auditor needs to be pre-approved by the audit committee. There's also a requirement for a lot of communications which go into the audit committee. Now, what is the audit committee? So you have the client having a board of directors and a management. So the board of directors, they hire the management, they oversee the management. A lot of times, even the management, the CEO, CFO, they are a part of the board of directors. Now, the rules require an independent audit committee. An audit committee or the board of directors which is not taking part in the management role. So you have people in the board of directors who may be taking part in the management role who are independent. So you form an audit committee out of those independent board of directors so that they can take care, they can oversee the audit function of the company. They can make sure the internal audit is working fine and the audit committee appoints the external auditor. The audit committee has a lot of communication going on with the auditor. So let's say the auditor has some problems with the management. They see that the management is having a scheme of money laundering, let's say. In that case, they go to the audit committee, which is independent of the management, and tell them, look, there's a fraud happening out there, and the audit committee takes appropriate action. So that is about the audit committee, pre-approval, audit committee communications. Now under SOX, there is also a requirement for auditor or audit partner rotation. So SOX requires that the audit partner needs to rotate off the audit every 5 years. So let's say I'm a partner in an audit firm and I'm doing audit for a client. After 5 years, I need to get off that audit and some other partner would take care of that audit. Note, this is an audit partner rotation, not an audit firm rotation. So the firm would remain the same. Basically what happens is there's a permanent file in audit. The firm, the CPA firm gets a lot of understanding about the company. So they don't want the firm to go on and off. They don't want a new audit firm every year, but the audit partner changes every 5 years. So it's like, I'm the audit partner. I know the CEO so well. We become friends as we do audits over the 5 years. After 5 years, I'm taken off so that my independence is not impaired. So guys, this audit partner rotation is very important and comes under title 2 of SOX. Now let's talk about the third title in SOX. The third title focuses on corporate responsibility. Now, I already told you about the audit committee. So we have an audit committee, an independent audit committee, which makes sure that corporate responsibility is followed, which makes sure that management acts in the best interest of the shareholders. There is no false profits, there is no fraud happening. Now, they have very strong provisions under SOX. It says Rule 302. So it's Title 3 and it becomes Rule 302 of SOX, which requires management to maintain proper internal controls. Guys, remember when I introduced GAS to you, I said management is responsible for the financials. We as auditors, we are responsible for our opinion on the financials. We are not directly responsible for the financials. Now, under SOX, they said it's a big company, right? Public company, issuers. They need to have strong internal controls that create these financials. So it says management has responsibility for internal controls, and it's very important to have those strong internal controls over financial reporting. Under corporate responsibility, they have another very important rule, 303. Now, this rule requires that management should not try to improperly influence the auditor. They should not try to make the financial statements misleading. So it says no improper influence on auditors. So guys, we are trying to instill a strong sense of corporate responsibility. I told you, right, after the frauds for Enron and Arthur Andersen, there was a question on corporate responsibility. There was a question on the CPA profession. So we're making sure everything works well. The management, they are more responsible, and the auditors, they again are much more responsible. They keep up, they live up to the profession. They live up to being certified public accountants. So you have corporate responsibility or having an independent audit committee that makes sure there is a lot of corporate responsibility, corporate governance out there. 302, management responsible for internal controls. 303, it says no improper influence on auditors. We can also add this point of no insider trading. Now what SOX did is, think about it. There is a sign there which says no littering. In another place, there is a sign, no littering, fine, 10,000 bucks and 1 year in jail. Guys, that is what SOX did. It said what already existed, but it clearly said, if you're doing this fault, this is what your penalty is. This is the fine that you have to pay. This is the number of years you have to spend in jail. They made it very strict. So it said no insider trading. Everybody knew that even before SOX came, but now the rules became much more stringent. The penalties became more pronounced. So we have insider trading provisions in Title 3. There's a little bit more in Title 9 where you have the white collar penalties. We'll look at that when you're going through the book. Now let's look at the next SOX title, Title 4. So Title 4 is basically dealing with enhanced financial disclosures, enhanced disclosures. Remember we said the management gives us the financials, we as auditors express our opinion on the financials. For the internal controls, we decide how good the internal controls are to decide how much of test of controls to do or substantive test to do. Now, SOX came up with a requirement for integrated audit. Now this is an audit of financial statements integrated with an audit of internal controls over financial reporting. So guys, we as auditors, we are now not only auditing these financials, we are also auditing the internal controls that the management has in place to create these financials. So it's an integrated audit. We integrate the audit of financial statements with an audit of internal controls over financial reporting. We express two opinions. We express one opinion on these financials, whether these financials are true and fair, and we express a second opinion on the internal controls that create these financials or the internal controls over financial reporting. Guys, this is the importance that SOX has brought to internal controls. If internal controls are strong, the financials, there's a higher chance, a higher probability for these financials to be true and correct. So there's a lot of focus on internal controls. Here we said management is responsible for internal controls, and here we are saying that the auditor not only audits the financial statements, he also audits the internal controls over financial reporting. So this comes under rule 404 of SOX. So you have rule 302 which says management, you are responsible for internal controls. 404 says auditor, you're not only doing a financial statement audit, you are integrating that financial statement audit with an audit of internal controls over financial reporting. Guys, this is very important. We'll talk about this again in audit 3 when you're doing internal controls. We'll look at auditor reports when the auditor has an option of either issuing separate reports. One report on the financial statements, the other report on the internal controls over financial reporting. Or the auditor can give both the opinions on a combined report. We'll talk about that. Now under Title 4 enhanced disclosures, there's also a requirement for real-time disclosures. So you have real-time disclosures of material events to the SEC. So the company is required to have real-time disclosures. I mean, if there's any material event which happened in the company, let's say the CEO resigned, there's some trouble, you need to disclose it real-time to the SEC so that everybody knows about it. So guys, this is basically what the SOX structure that we have on the CPA exam. Very important. I'll just go over it quickly once again. So you have the Sarbanes-Oxley Act in 2002, very important act, create a lot of new rules, made sure that the management is responsible and the auditors are responsible. It created the Public Company Accounting Oversight Board to oversee the auditors of issuers. The auditors of issuers are required to be registered with the Public Company Accounting Oversight Board, which also has its bunch of auditing standards, which is GAS plus more. Then you have Title II, providing more stringent rules for auditor independence. It says an auditor cannot provide non-attest services like consulting to an audit client. It requires auditors to have audit committee pre-approvals, make sure that there is ongoing communication with the audit committee, requires audit partner rotation every 5 years. Title III of SOX makes sure that the management, they are more responsible, corporate responsibility. There's an independent audit committee. It makes sure that management is responsible for internal controls. It provides that management must not improperly influence auditors. Certainly no insider trading. Title IV talks about more enhanced disclosures. So you have auditors doing an integrated audit, an audit of financial statements integrated with an audit of internal controls over financial reporting. Guys, 2 audits, 2 opinions, all integrated into one.
On page 15, we've got the Sarbanes-Oxley Act, SOX, which was passed in 2002. Now, SOX is heavily tested on the auditing part of the CPA exams. It's also tested as part of securities laws on the regulation exams. For BEC, you need to be familiar with titles 3, 4, 8, 9 and 11, which we will look at in the subsequent pages. Highlight Title 3, Corporate Responsibility. Each issuer needs to have underlined an independent highlight audit committee. And right there, audit committee equals no role in management. So audit committee comprises of a few independent directors from the board of directors who have no role in management. Next, highlight section 302, which requires that highlight management, including the CEO and the CFO, certify periodic reports filed with the SEC, where officers are responsible for the financial statements and highlight officers are responsible for internal controls. And right there, management responsible for internal controls. Highlight section 303, improper influence on conduct of audits, which prohibits any officer or director of any issuer to fraudulently influence, coerce, manipulate or mislead the auditor for the purpose of rendering such financial statements materially misleading. Then section 306, highlight prohibits insider trading by officers or directors during a pension fund blackout period. Highlight Title 4, Enhanced Financial Disclosures. So 402 under Title 4 prohibits personal loans to directors and executive officers. 403 talks about directors, officers and 10% plus stockholders. Put a bracket around this and draw an arrow which says related parties. So guys, SOX Title 4 says that all these related parties, they are required to disclose stock transactions within 2 days. Highlight the next one, 404. Auditors required to attest to management's assessment of effectiveness of internal controls over financial reporting. Very important. And put a note here which says integrated audit is equal to audit of financial statements F/S plus audit of ICFR, that's internal controls over financial reporting. So it's an integrated audit when the audit of internal controls over financial reporting is integrated with an audit of financial statements. Then you have rule 406, which talks about the code of ethics. 407, it says must disclose whether, highlight, at least one member of the audit committee is a financial expert. You're not required to be a CPA to be a financial expert, but generally if you're a CPA, you are a financial expert. So guys, be all set to become financial experts. Next one, highlight real-time issuer disclosures. On Title 8, highlight Corporate and Criminal Fraud Accountability Act of 2002, which makes it a felony to knowingly destroy or create documents, including audit working papers, to impede, obstruct, or influence any existing or contemplated federal investigation. It says that highlight auditors are required to maintain all audit working papers for 7 years, and which provides for highlight whistleblower protection for employees of issuers who provide evidence of fraud. And of course, highlight criminal penalties for securities fraud, which includes fines and or up to 25 years in prison. Title 9 includes highlight white collar crime penalty enhancements. Section 906 is about highlight corporate responsibility for financial reports, which requires the CEO and the CFO to certify periodic reports filed with the SEC. For example, the annual 10K, the quarterly 10Q, and there are highlight criminal penalties for willful violation. Again, up to $5 million in fines and or up to 20 years of jail time. We are looking at a few other related acts. First one here, highlight the Private Securities Litigation Reform Act, which was passed way back in 1995, which requires auditors of issuers to highlight detect related party transactions, highlight illegal acts, and highlight going concern issues. Now, for illegal acts, it requires auditors to investigate and underline quickly notify that illegal act. So the auditor shall inform management and ensure that the audit committee or the board of directors is also adequately informed. The board needs to inform SEC by next business day and furnish a copy of the notice to the auditor. Now, if the board does not do that, then the auditor directly goes to the SEC within 1 business day after that. So right there, auditor goes to board of directors, who then inform the SEC. If the board does not do the job, then the auditor directly goes to the SEC under the Private Securities Litigation Reform Act. Now, over the years, the US Congress has exempted certain issuers from integrated audit requirements. So right there, no integrated audits required for and underline the Dodd-Frank Act of 2010, which exempted issuers classified as highlight non-accelerated filers from complying with the integrated audit requirement. Now, a non-accelerated filer is a company with a public float of less than $75 million. Next, we have underlined Jobs Act of 2012, which exempted issuers defined as highlight emerging growth companies from complying with integrated audit requirements. Now, emerging growth companies or EGCs are companies allowed to go public via an IPO with relaxed compliance requirements for underlying the first 5 years as if an IPO on ramp.